Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Equitrans stock and analyzing its financial ratios. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or support the channel, you can become a member by clicking the link in the description below. Equitrans is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This is a mid-cap company. Market cap is $3.6 billion. That's the value of the company according to the stock market. And they're trading at $8.38 a share. To get shares outstanding, it's market cap divided by stock price gives you shares outstanding, 430 million. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then you discount that back to today's dollars. That's what we're doing in this video. Free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are property, plant, and equipment. And if a company has positive free cash flow, it has the ability to pay down debt, pay dividends, acquire other businesses, or invest back into the business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. And this company's free cash flow is up and down. It's negative, then positive, negative, then a small positive. Net income is a profit and loss on the income statement. It's revenue minus expenses. Their net income does look good for 3 of the 4 years, but it has a negative in 2019. Their revenue looks really good. It goes from $732 million to $1.6 billion, so more than doubles in 3 years. So it looks like they're doing a good job growing the company. Let's look at the financial statements to see why there's so many negatives. In 2019, they had a negative $65 million of net income. And the way the income statement starts is with revenue. That's the top line, the sales. Below that is cost of revenue. That's how much money the company spent to generate these sales. Then you have the gross profit, which is the revenue minus cost of revenue. Then operating expenses. These are the expenses that are not directly related to making your products. So an example of an operating expense is payroll for marketing or payroll for accounting. Those jobs do not directly make the product, but the payroll for the workers on the oil rigs are part of cost of revenue. Then operating income, which is gross profit minus operating expense. So you want to make sure when you invest in a company, it has positive and pretty healthy operating income, because if it can't even make money on its everyday operational business, it cannot sustain a business for a long time. Then below that is the interest they pay in their debt. And you want to make sure that the operating income is above that, so they have money left over to pay dividends without going into debt. Then there's other, because companies sometimes make money or lose money that is not directly related to their core business. The reason they had negative net income in 2019 was this $969 million impairment of capital assets. I looked on a company's 10K, and this impairment was goodwill, but other things can be impaired, like accounts receivable or other fixed and intangible asset. Goodwill can only happen when you acquire another company. If you wanted to acquire a company X, goodwill equals the premium you paid for company X. The value of company X is equal to the equity section of the balance sheet, or you can take total assets minus total liabilities. To give you an example, say you acquired company X for $10 million. According to company X's balance sheet, it was worth $7 million. The way you would know it was worth $7 million is because the assets minus liabilities equal $7 million. Once the acquisition is complete, you would move all of company X's assets and liabilities onto your balance sheet. Remember, the assets minus the liabilities equal $7 million, but you paid $10 million. You have to plug in $3 million into the asset goodwill to accurately reflect the $10 million acquisition price. Every year following the acquisition, you have to test for goodwill impairment. That means you have to figure out what the value of company X is currently worth. Next year, if you deduce the value of company X is $9 million, you would have to reduce your goodwill from $10 million to $9 million and also pass through a $1 million loss onto the income statement. The $1 million will bring down your net income, but does not affect cash, since the cash occurred when you acquired the company last year. So you can see the impairment of $969 million dragged down their net income to negative. So we can see the expense of $969 million on their income statement. Let's look for it on the cash flow statement. In the cash flow from operations section, you can see the $969 million is added back because CFO starts with net income, then adds back non-cash items. That's why free cash flow is positive that year. In 2018, the net income was $511 million, but the free cash flow was negative $144 million. Let's look to figure out why. So free cash flow is cash flow from operations minus capital expenditures. So you can see they had a lot of capital expenditures, $865 million, but they also had lots of CapEx in 2019, but they didn't have a negative free cash flow in 2019. There's lots of things going on the statement of cash flows, but what was different in 2018 than other years was a change in working capital. Because when you calculate cash flow from operations, you start with net income, you add back the non-cash items on the income statement. Also, you have to adjust for working capital. Working capital is changes in accounts receivable and changes in accounts payable. So when you use accounts receivable, you're providing a product to a customer, therefore you're booking that revenue onto your income statement, but you're not receiving any cash for it. You should receive cash in the near future, but at that time you don't receive any cash. When you use accounts receivable, that negatively affects cash flow. So in 2018, they had negative $36 million of accounts receivable. But you can see in 2019, they had a positive $17 million, so their customers paid them in 2019. Accounts payable is the opposite. When you use accounts payable, you're receiving a product but not paying for it, so it helps your cash flow. But the reason it's negative in 2018 was because it looks like they received product in the past. In 2016, they received $87 million on accounts payable, but they have to pay it back at some point. So when they do pay it back, it's a cash negative. Changes in working capital had a negative $230 million effect on their 2018 cash flow from operations, which brought down their free cash flow to the negative $144 million. So you don't really get that much information from looking at 1 year of financials. You have to look at multiple years to figure things out. It's kind of like a puzzle. Let's look at a capital structure. They have $6.3 billion of debt and $673 million of equity. They pay 4.05% interest on their debt, and cost of debt is 3.23%. To get cost of debt, it's interest rate times 1 minus the effective tax rate. And they're really leveraged. They have 90% debt in their capital structure. That means they have 10% equity. Cost of equity is 17.68%. To get cost of equity, we use a capital asset pricing model. And part of the CAPM formula is the beta. Beta is a measure of stock's volatility in relation to the market. The S&P 500 has a beta of 1. This stock has a beta of 2. So if the S&P goes up 1%, this stock should go up on average 2%. And if the S&P goes down 1%, this stock should go down 2%. Beta is calculated using regression analysis. Regression analysis allows you to examine the relationship between 2 or more variables. Beta is systematic risk related to the market, like interest rate changes, policy changes, wars, etc. Systematic risk cannot be diversified away. Unsystematic risk is the risk of an individual company, which can be diversified away by adding more stocks to your portfolio. And their WACC is 4.62%, which is a blend of the cost of debt and cost of equity. The WACC is a discount rate companies use when they want to take on new projects. For example, if a new project came along that cost this company $1 million up front to take on the project, and it would generate $100,000 of cash each year for the next 20 years, the company would discount those 20 years of cash flows back to today using the weighted average cost of capital. If the present value of the future cash flows equaled $1.4 million, the company would take on the project. Since it cost them $1 million, they would make a $400,000 profit. But if the present value of the 20 years of cash flows equaled $800,000, then the company would not take on a project since it cost $1 million. They would be losing $200,000. You only want to take on projects that add value to the company. The WACC is a discount rate we are going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated all cash flows past year for that $17 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5 billion. We divide that by 430 million shares. And we get a calculated stock price of $11.57. They're trading at $8.38, so they're trading at a 28% discount. It's a buy according to the model. Simply Wall Street has them valued at $17.52, so they're saying the stock is even more undervalued. Simply Wall Street takes the average analyst estimate to come up with their valuation. Let's see where the stock has been trading at the past few years and look at their historical dividends. The stock started trading at the end of 2018. It's like it broke through $20. It seems like the stock has been on a steady decline for a couple of years now, so it looks like it could be a really good value if this company can get through coronavirus. Their dividend payment was 41 cents, 45 cents for several quarters, but they dropped it to 15 cents, probably to conserve money. Their current dividend yield is 7%, which is a lot lower than the average oil and gas midstream company. But dividend yield can go up if the stock price goes down, and dividend yield can go down if the stock price goes up, since stock price is part of the dividend yield formula. It is good to remember that a company's financial performance is not 100% correlated to the stock price. It may help or hurt the stock price. The only thing that is directly correlated to the stock price is supply and demand of the market. The stock price will go up if more people want to buy a stock, and will go down if more people want to sell a stock. It is possible for a company to report great financials and its stock price keeps going down. It is also possible for a company to report weak financials and its stock price keeps going up. The market is forward thinking. Many investors look toward the future and not the past. Part of investing in the stock market is understanding market sentiment and investor psychology, which can be the hardest thing to figure out. Let's look at the financial ratios. Negative PE, the market median is 16.1, the average is 17.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a negative PE, so we can't look at that ratio. They have a good price of sales. The median is 2.0, the average is 4.7. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 2.2. So investors are paying $2.20 for $1 revenue. Price to book is a little high. The median is 2.3, the average is 4.9. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 5.4. So investors are paying $5.40 for $1 book value. Equity is total assets minus total liabilities on the balance sheet. A good interest coverage ratio, the median is 4.0, the average is 13.0. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0, they're at 4.2. So they can easily cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. ROE is negative. The median is 12%, the average is 13%. ROE is net income over equity. They have negative net income, so they have negative ROE. Good current ratio, the median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2, so they can cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables that are due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios to compare them to similar companies, I've done videos on 28 oil and gas midstream companies, and Equitrans is right here. And if they have a number in red, they're worse than the average. The average is over here. So they do have a negative PE, so of course they're worse than the average. They don't have a bad price to sales ratio, but it is a little worse than average. Price to book is slightly worse than average. Current ratio is fine. They do have a negative ROE, so of course it's worse than the average. But remember, that's due to a large goodwill impairment. If we took that out of the equation, they probably have a decent ROE. They are really leveraged, 90% debt, much higher than average of 63%. Market cap of $3.6 billion, which is lower than average, and they pay a 7% dividend, average is 12%. So to summarize, I have them trading at a 28% discount because their stock price keeps coming down, so it looks like a good value according to the model. Their ratios look a bit weak, and their financials are all over the place. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or support the channel, you can become a member by clicking a link in the description below. Thanks for watching.